Brings us now to our final discussion of the day. We've spoken throughout the morning about some of the factors changing the global trading landscape, growing protectionism, the tensions between China and the US, Brexit, rapidly increasing trade between the Middle East and Asia. But perhaps the most profound changes will be driven by technology. New technology, from artificial intelligence to robotics to digital currencies, they're likely to transform economies, businesses, and societies over the coming decades. In the trade arena, digitalization can lower the cost of transactions, it can increase the speed of delivery, and drive trade growth beyond geographic boundaries. But there are some obstacles. Regulators are struggling to keep pace with the rapid changes in technology. Legacy IT systems among big established players and developed economies, and the sheer pace and scale of the change. Now, we have many conversations at Asia House about the factors which will drive the world trading architecture over the next decade, and technology is overwhelmingly rated as the most significant possible game changer on the horizon. In 2016, DMCC conducted a comprehensive piece of research on the future of trade. One of the key findings of that research was that digitalization would lead to a six-fold increase in the number of companies exporting. Now, DMCC is close to completing its 2018 research on the future of trade. The results will be released next month, and I can't give anything away, but I'm fairly sure you can count on technology being featured very heavily in the findings. So let's look at the digitalization of trade. I'm joined by Abhijit Prasad, Managing Director, Global Head of Product Management, Global Trade Receivables and Finance at HSBC, Kaiser Nazim, Head of Banking and Digital Finance Advisory Services, Middle East North Africa at IFC, and Anthony Butler, Chief Technology Officer for IBM's blockchain practice in the Middle East and Africa. Please welcome our guests. Anthony, let me start with you. You're the head of a blockchain practice. A few years ago, I doubt a blockchain practice even existed, and now you're leading up a piece of business there. Blockchain comes up routinely in discussions. One, what is blockchain? I've heard descriptions, but better coming from you. Secondly, what impact is it having on global trade?
Sure. So I think the easiest way to describe blockchain is as a shared distributed ledger. So if you look at the way that the world has operated, supply chains have operated, any business network has operated up until now, every participant in that network would maintain their own ledger. They would maintain their own record, their own view of the truth. And the way in which the network would function is everyone would exchange paper. So when an asset moves from one participant in this business network to another, there would be some paper that would accompany the flow of that asset, and each participant would update their ledger. They don't trust each other, so you would need auditors and regulators who would need to monitor the integrity of the business network. And this is the way that the world has pretty much operated for hundreds and hundreds of years, ever since some Franciscan monks invented the concept of the ledger in the 15th century. What blockchain does for the first time is it allows all of those participants in a business network to see the same ledger at the same time. So whereas before there was distrust and there was the exchange of paper that accompanied that network, now everyone has a real-time view of the truth. They all have consensus that this is the truth. And so this has allowed us to drive a lot of efficiencies and transform the way in which these networks operate around the world. Now, if we take the global trade, I'll give you a real-world example. So about 2 years ago, we did a piece of work with Maersk to trace the flow of goods from Mombasa in Kenya to the European Union. And in this case, it was a container of avocados. And what we found is in order for that container to reach the EU and clear customs, there was 30 entities that had to participate in that transaction. There were over 100 people who had to touch that transaction. And there were 200 exchanges of information that took place in order for that simple container of avocados to reach its destination in Rotterdam from Mombasa. And so we realized that there was the potential for blockchain to fundamentally transform the way in which global trade is executed. And so after the successful proof of concept or that successful experiment, we started working with Maersk, AP Moller-Maersk, who's one of the largest container companies in the world, to look at the digitization of global trade. Now, the cost of trade globally is roughly about $1.8 trillion, and based on some studies that we carried out with Maersk, we found that 20% of that cost related to paper. So it is an incredibly inefficient process. There are many moving parts. There is a lot of paper that's involved, the bills of lading, certificates of origin, various types of advanced clearance certificates related to customs. So what we were able to do is take all of that and put that on the blockchain. And by doing so, we're already seeing very, very impressive results in terms of removing latency and friction from global trade, but also improving visibility and transparency into the container supply chain, which benefits, for example, customs agencies. So previously, a customs agency would receive a container, and they would have limited view into what was in that container, where it came from, what was the provenance of the goods inside that container. Now, with the blockchain, it's possible to look all the way back to the factory. So even though the manifest may say toys, the customs agency can now say, well, this is coming from a factory that is a fireworks factory, so we will treat that container differently than if it originates with a factory that perhaps is known and trusted to make conventional children's toys. So in essence, what the blockchain is giving us is more visibility, more transparency, and ultimately more trust and more efficiency in our global supply chains.
Kosta Nazim, let me come to you. The sweeping changes in technology, and they are extraordinary changes and happening very quickly. Are they net positive for emerging markets, which aren't saddled with legacy systems, or is there a bigger issue at stake here? Can emerging markets, can developing markets seize this opportunity?
Thank you. Let me just put a context around the question. And the context, because we're a little different institution than others. As you may know, the World Bank Group, the IFC, I mean, our purpose in life actually is to ensure financial inclusion, ensure alleviation of poverty, and ensure that the benefits of economic development are trickled down to the lowest levels in countries of the world. And we work with emerging markets, mostly in emerging markets. Now, like in any other sector, technology today in 2018, and even in 2017 and 16, is a great enabler for anything. So whatever can be done for economic development anywhere, the efficiency or the effectiveness of that can be doubled or tripled leveraging technology. And the same we can say of global trade. Now, our interest in global trade is because we firmly believe that trading and trade flows between countries are the drivers of economic development. Trade is what creates jobs. Trade is what creates economic activity. And therefore, we are big supporters of ensuring trade flows, especially between emerging markets and developed economies. And there are a lot of programs that we have in place. I'm not going to talk about them in that particular area of encouraging trade. Now, having said that, in 2018, technology is affecting the way we are doing our business. All of us are doing our business. On one side, it perhaps may shift the production of goods and perhaps even services to countries which had outsourced it initially because of costs of production. So the developed countries had outsourced a lot of services and production activities and manufacturing activities to emerging markets because of lower labor costs. So one effect could be that they come back because of the lowering of the cost of production. So that would have an adverse effect on emerging markets in terms of employment opportunities. The other, as we heard, is the paperwork involved in these trade works and the inefficiencies because of the documentation can be reduced because of using technology called blockchain, which has started, it's still emerging. I think less than 0.1% of world trade right now is being driven by that, but there's a lot of potential in it. Technology would also enhance trade flows or trade finance because of equipping the financial institutions with the ability to faster and quicker process trade finance activities. So I think that will have a big effect on it. The third, of course, which I'm sure we may have spoken about this morning, but it would be spoken about, is e-commerce. So the boundaries of these trade flows and the inefficiencies because of these boundaries are also disappearing. And today you can order, anything from anywhere in the world, and it'll be delivered to your doorstep very fast, perhaps within 24 hours. So that's a big effect on the way trade flows are going to develop. In terms of legacy systems and emerging markets, a big part of the work that we are doing is trying to ensure that companies, banks, financial institutions in emerging markets of Yemen, of Iraq, of Morocco, of Pakistan, of India, are able to understand and leverage these technologies. So a lot of work we do is trying to bring an understanding to these markets of why they need to adapt and leverage technology for trade flows or for anything else that they do, and how they can do that. And I think the most important part of the how is the strategizing of how they can leverage these technology in a strategic manner, keeping in view what we discussed earlier, that these trade flows are not only because of the fact that it's cheaper to import from a certain country or more effective, but there are political elements to that also. How we digitize the political part, I think that's something we still have to discover, and I think this is again something we spoke that every day we are trying to understand and trying to see where these global trade trends are leading us to. And frankly speaking, I would venture also to say that I don't think any one of us has an answer of what tomorrow is going to bring in terms of trade flows between countries and in terms of how these trades are going to be developed and taken forward. Last comment I would like to make that on top of all this, including when we talk about legacy systems of technology, there are legacy systems of the regulatory frameworks. And a lot of these enablements of technology or the ability to leverage technology would have to depend on how the regulation around these technologies takes shape. One thing I am certain, and that's something I keep repeating in most of the conferences I attend, is that regulation will always track innovation. So we will never be in an environment which the regulatory or the ecosystem is perfect for us to start using technology. So the innovators will take the lead. The blockchain technology, taking care of documentation, the fintechs taking care of how you, provide financing to trade will take shape, and the regulations will follow. But this is again a big issue, and I think one of the hurdles. So I'll just stop here for now.
Thanks, Ray. We will get back to regulation because that is a big piece of the puzzle going forward, and it's universally accepted that regulators are lagging behind the technical innovators, possibly, well, partly because of the speed with which things are changing. But Abhijit, let me come to you now. Kaiser also mentioned trade finance. And so how does trade finance, how does that need to be reshaped, or what are the opportunities there for trade finance in a world where technology is changing the way trade happens?
Thanks, Michael. Notwithstanding the comments made in the past about protectionism and the US-China trade wars potential issues, actually being a technologist as a prior career, I'm absolutely extremely optimistic on how technology is going to shape trade and trade finance. And I think it's probably not been a more exciting time to be involved with trade and trade finance, because we've talked about blockchain as one of the technologies, but there's kind of a host of other technologies which are transforming how not only trade is being done, but how trade finance gets offered. If we think of the last big innovation which happened in the world, which transformed how trade was being done, you can almost trace its way back to the 1950s when the container or the standardized box was put together. And that kind of slashed loading costs by about 97%. It reduced insurance costs, took away inventory costs, and sort of things like that. Since then, we've seen marginal changes to how trade gets done and how documents get processed and how financing gets done. But I think we're at an inflection point now with digitization going to completely transform how trade and trade finance gets offered. I'd kind of split it into two parts. How trade actually is happening between buyers and sellers globally. And if you think about how that's transforming, when we thought of trade, we always thought of big ships with large containers moving across the globe. But as services as a percentage of GDP rises, and it's exponentially rising over the past 10, 20 years, that's not going to be a ship that's going to move across borders. That's going to be data that is going to flow from one entity to the other. Technologies like 3D printing are going to change how trade flows move. You're not going to require a good to be transported from somewhere in China to the West. It's actually going to be software or data that's going to be provided from a producer of that or designer of that good to the purchaser. The other is cloud services. I mean, I don't know about you, but I don't have a hard disk at home anymore. I store all my data on a cloud, and that is increasingly being applied to corporates as well. And cloud services change how people pay for things. You don't buy a product. You buy a service which you pay for on a pay-as-you-go, use as you go basis. So that's going to change how people buy. E-commerce marketplaces, Kaiser talked about it. I don't know if you've heard of WeChat, which is kind of a fusion between Facebook and WhatsApp, which allows financial transactions. That's changing how transactions are done in China, and it's going to kind of spread across the world. So that's kind of one lens of looking at how trade gets done. As a result, what banks and financial institutions need to do is we need to transform how we offer our products and services so that we stay relevant and we continue to be able to provide financing for a trade that happens. Our processes were traditionally always designed for goods moving across borders, and therefore, you've got a letter of credit that gets offered, you've got documents that go with that. If you've got a cloud service that gets offered, or if you've got 3D printing, which involves movement of data, the requirement of a document goes away. It's a very, very different kind of trade that occurs, and therefore, banks are needing to evolve themselves to be able to support and finance those kind of flows. The second lens is technology that is transforming trade finance by itself. And what I mean by that, and we talked about blockchain and digital ledger technologies, but there are a host of other technologies, optical character recognition, which is going to take paper away and is going to transform the data that exists on paper into digital form. Artificial intelligence and robotics, which is going to automate processes which would normally require somebody to do some manual work, is going to transform how things happen. Smart contracts, which is again a use case for what blockchain can enable, can kind of improve how buyers and sellers can agree when things get done. Big data analytics, which allow banks to mitigate their own risks. So when you've got data on how buyers and sellers or entities deal with each other, you can mitigate your credit risk, you can mitigate financial crime risk, anti-money laundering risk, which is something which banks are held to very high standards to, as you know today. And so I think we are extremely excited and embracing all the technologies that are transforming how trade and trade finance get done.
Anthony, blockchain is part of the change, but it sounds like a significant part with enormous potential. Kaiser mentioned a number. It accounts now for a tiny percentage of world trade. What's your expectation in terms of growth for blockchain use in trade?
So I think we're at an inflection point. So if I look at the work that was done last year, a lot of it was proofs of concepts, experiments, proving the viability of the technology, but also the business transformation that it enables. What we're seeing this year, even though we're only in the second quarter of the year, is there's been an uptake in the sense that we're starting to see real value that's moving across these networks. Much more serious adoption of the technology. So if last year was the year of the proofs of concept, we're seeing this year as the year of the active network, where we're starting to see more serious adoption.
Can you put any numbers around that? You see any percentage increase? Is there any sort of tangible number you can put on that? Do you expect a 10% increase in the use of blockchain? Or give us some sort of sense of scale.
Well, it's hard. It's hard to quantify because by definition, these networks, we don't have visibility into everything that's flowing through them. But if I'll use the example of Maersk, right? So to show how there's been a shift in the level of seriousness. So last year we were working with Maersk, proving the idea, proving the technology. 16th of January, we decided with Maersk that this is serious, and we launched a new company that is going through the process of getting regulatory approval. The EU approved it now. We have multiple ports. We have Rotterdam, we have Port of Houston that have joined this network. So we're seeing serious investments and serious adoption, and this will only continue for the rest of the year. And that's just one example.
Okay, very happy to take questions from the audience, please. So if you'd like to ask a question, you were first up by such a long margin. Please, microphone up here. Thank you.
Thank you for a very interesting discussion. My name is Gayane African, and I'm a senior economic policy advisor with Dubai Department of Economic Development. My question is to Anthony specifically, and this is because I don't know well enough about the answer. Now, the blockchain gives a lot of transparency. Have you come across to the issue of commercial aspect of the companies, especially shippers, who very much want to keep it more, less transparent, or let's say not less transparent, but because of commercial reasons, they don't want to display all the information about shipments, volume, size, etc. How is it covered on blockchain? Thank you.
So, although it is a distributed network, it's shared, it's replicated, but there is still the ability to introduce privacy. So, exactly to your point, one shipper doesn't want the other shipper to know the volumes that they're taking through a certain port. Likewise, one custom authority doesn't necessarily want the custom authority of a neighboring country to be able to look at what volumes they're processing. So, the technology has the ability to create partitions or channels. So, only the participants in a particular supply chain can see the data within that supply chain. So, for example, the two customs agencies can see everything, but the shippers will only see what is related to them and what they're permissioned to see. So there's definitely the ability to introduce privacy. This is an intrinsic characteristic of it.
Maybe also just to add to that, from in a financial world, privacy and data kind of be relevant only, or be visible to people only who it's relevant to is very, very important. And so what we've seen is, like you said, permission networks, where you can have permissions granted specifically to entities who are allowed to see that data, and only those can see it. And those are actually the applications that we see in a financial context, which blockchain can help.
Because the push of regulators now is primarily to protect data. There's GDPR in Europe, other moves, and what some might describe as digital nationalism. How does that square with blockchain and the other technology changes that are supposed to create frictionless trade?
So GDPR, particularly the right to be forgotten, introduces challenges with blockchain that are being worked out from a technical perspective. In terms of the regulators and in terms of how governments are viewing it, the same rules apply with blockchain that apply to cloud computing or any other type of technology in terms of what you can share with entities outside the country. So all of those rules, they don't go away. In the case of global trade, we've seen a massive amount of interest from customs authorities, for example, because we're actually giving them more visibility and more insights than they would have otherwise had. So they've been very, very early and very aggressive adopters of the technology within that global trade context. And similarly, in other industries, we're seeing that the regulators are also very interested in the technology because it allows them to have more visibility into those business networks where otherwise it would have been very opaque. So we're actually seeing a lot of interest from regulators.
So regulators are interested, but there are issues around privacy, and there needs to be a technology adaptation to embrace new regulations.
and policy.
Yeah. Would you agree that is this an impediment to innovation, which will lead to more trade?
Well, I wouldn't go as far to say it's an impediment. I think it's something that we need to think through and define rules for. So, for example, the rules governing documentary credits or letters of credit were devised in the early, 1920s, 1930s, I think, and that's been what has been used. It's known as the UCC. That's what is used as the laws for which govern, for example, letters of credit. Those need to be thought of in the context of blockchains. And if you've got data which is visible to everybody, those rules need to be revised. And in fact, the ICC has got a working group which is defining rules and regulations and standard practices which could be applied to those instances. So I won't go as far to say it's impediments. It's there's things that we need to work through, because transactions on blockchain, at least in the financial sector, have not really become reality as yet. We've had lots of proofs of concept, as Anthony said, but not really.
Kaiser.
Yeah, if I may add, since we're on data, and I would say you're absolutely, I agree with you, it's not an impediment, but it does become an impediment because of market forces. So it may not be a regulatory impediment right now, because any impediment can be addressed through regulation and, like you said, thinking it through. However, before that happens, and you have started a technology which, well, we saw it happen recently, right, with Facebook. So the market forces can make that an impediment and slow down. So again, I come back to what I said earlier, and this is something when we are working with institutions in emerging markets, because that's where we work, is strategizing. And you should always have a strategy of data as well. So how will you ensure, or what type of data, first of all, are you going to collect, analyze, and draw insights from? It should be strategized. So there should be a strategy around that. And then who has access to that data within your own institution as well as from the outside. So all this has to be strategized. And if you don't do that, we've seen a lot of companies fail or falter because of that, and they are every day. So technology actually is, like anything else, is double-edged. So we need to tread carefully. We need to innovate. We should not impede innovation. But simultaneously, and that I think I should mention, I alluded to it earlier, is what we do in the World Bank Group, because we work with the private sector. So we would work with a bank. We would work with an institution to help them adapt technology. And while adapting that technology, there are impediments. Today, you cannot roll out everything because there's this regulatory constraint. So we work with the regulators that if you want to promote trade, since we're talking about trade, but anything else, financial services, financial inclusion, these are some things you need to change in the regulatory framework, but obviously responsibly.
Thank you. Next question, please. So one down there.
Good morning. My name is Beverly. I work for SNC Lavalin. To Anthony, I've heard it said that blockchain is where the internet was 10 years ago. Is that true, and where do you see blockchain going?
Yeah, I think that's absolutely true. So we are, with respect to blockchain, where we would have been at the beginning of the adoption of the internet. So what that means is that we still don't know where this is going to end up and what the ultimate value that this will deliver to the world will be. So it's very much a fair analogy, I think.
Would you agree? You talked about earlier an inflection point.
Yeah.
Is that where we are now, the beginning of the internet?
I mean, I'd go so far to say it's probably going to be the biggest change that we've seen from when the internet started, which started off in a few American universities as closed networks, and the blockchain networks that we are seeing are at the moment still closed networks. So they're networks on specific use cases, either bilateral or with a few groups of entities together. Where we see this going is a network of networks and a network of networks, to be frank, where it is going to be linked, networks being able to talk to each other, and that's a learning in the consortiums that we are part of. We see that as a base requirement that the network that we are creating should be able to speak with another network that may be set up. So we actually see this going to transform how business gets done.
So you can see, for example, within the context of global trade, we have one network that is now managing the supply chain with respect to the physical movement of goods, the containers. We have another network that will be addressing the financial movements associated with the physical movement, which is a trade finance network. And then there'll be other networks that will be there to give visibility into the provenance of the goods and the products that go into those containers. For example, we did some work with Walmart in North America to basically put the supply chain of food on a blockchain to facilitate product recalls and give confidence in the quality of food. So these are three discrete networks, yet what we will see over time is there will be a convergence because they are adjacent, they are in some ways interconnected. So this is where I think it is going, and we can already see there's projects now that are looking at how do you bring networks together, how do you deal with the convergence of protocols, so very similar to the intranets and closed systems, how they were eventually integrated into one internet. We're seeing the same phenomena within the blockchain context as well.
Okay, quite extraordinary. Next question, please. Sorry, there's one down there. Oh, sorry, up here, forgive me. Thanks.
Thank you. So my name is Noor Adhami, and I'm the Regional Head of Liquidity and Cash Management for HSBC in the region. I think there is consensus and acknowledgement that digital is the way forward, but when I speak to the corporates that we bank with, there are two concerns mainly. One is cybersecurity, and what we've seen that the cyber attacks have been on the rise last year, as we see in digital developments also on the rise. But the other one is the development of digital law. And in the case of litigation, how comfortable are we as banks, for example, in terms of letting go of paper, ink signature, and move into something that is completely somewhere, either in the cloud or on the channel or what have you?
Because it is a big shift, isn't it? Cultural shift to say we're not going to have paper anymore, it's all going to exist in the cloud. How do you tackle that? How do you convince organizations, individuals to go down that path?
So it is an adoption curve. So what we're doing initially is we're not replacing paper, we're augmenting it. So we're providing digital equivalents of the same paper document. So if I use the avocado example from Kenya, when that container presents itself in Rotterdam, there's still paper that's associated with it, but it becomes, over time, it becomes a secondary reference. And so we think as people become more and more confident in the digital record, they will start to move away from the paper record. And we're not inventing new types of paper. So we're not inventing a new bill of lading or something like that. We're very much replicating the paper that exists in the physical world. And from a contractual perspective, it's the same thing. So all of these blockchain-based networks that exist today, there is still traditional contracts that are associated with it that govern how disputes are reconciled, that apportion liabilities, et cetera, et cetera. So all of that is pretty much the same. Where we are going is towards this concept of smart contract, as was mentioned earlier in the panel, which is where more and more agreements will be represented as code, and that will run autonomously on the blockchain. And that's where you start to see new issues arise, such as dispute resolution. So if you and I enter into an agreement, and that agreement is executing autonomously, if, for example, it's related to the transfer of an asset and you don't accept that asset because it's not in the quality that you expected, how do we manage that dispute? So there is an emerging body of research around online dispute resolution techniques where, as part of that agreement, there will be a third party that we will mutually agree upfront is the arbitrator in case of any dispute. And for that contract to execute, it will need 2 signatures out of the 3. So if you refuse to sign, if you refuse to accept the good, I will then go to that mutually agreed arbitrator, and it could be AI, it could be a human, it could be a voting system. And if they agree that you should have, or that the transaction should continue, they will sign the transaction. So then we have 2 of the 3 signatures, and it will execute. So this is very much a nascent area of research, but this is where the industry and the technology is going.
Anthony referred to it as an adoption curve. Are you finding that with your clients?
Well, I don't think it's reached that point where it's become an issue as yet, but I think what's clear is legal frameworks are going to have to evolve, because at this point in time, we know legal documents are kind of enforceable when you've got something in paper, you've got signatures and with wet ink, and we get comfort when we see that. There's going to have to be some review of legal frameworks. We're going to have to see some cases actually taken to court, which are actually successful for that trust to build in. I think it's a question of time, but in the same way we've kind of got used to things online and not keeping paper documents. I don't keep any paper statements. I get all my online statements and I store them somewhere. In the same way, I think there's going to be trust that's going to develop over time, which will allow us to transform or get rid of paper.
Kaiser, are you finding that there is the cultural shift required for individuals and for organizations to accept going down this digital?
Yeah, absolutely. I mean, I don't think there's much to add to what's been said. It's a question of adapting, and it's a question of educating, actually, when we talk about emerging markets. And it's a matter of time. And the point is that it has to be an ecosystem. So it's not a question of whether you can develop legal documentation. It's also the regulation that we spoke about. So all these have to move in tandem. And I think, today we don't know what we don't know, but technology for sure is something that will ease the way we've been doing business going forward. I mean, that's something we know already. It's like watching Star Trek in the 70s, and we know where we are today. Absolutely. I mean, education, and I think more for people of my age, educating them. The millennials are natural born. They probably would expect things to be done more digitally. The way they live their lives, the way they bank, the way they travel, we all know that. So absolutely, yeah.
But I think to add to your point, I think a lot of most of the challenges will be more profound in the so-called mature markets. So if you look at way technology has been adopted in the, for want of a better word, emerging market. So you take Kenya, for example, they have a mobile platform called M-Pesa. At one point, I think 46% of the GDP of the economy was being transacted, in this way. And you look at the way WeChat has taken off in China. So I think, the interesting thing is that we're seeing that I think that the technology will be more aggressively adopted within the emerging world.
And give the emerging world, emerging markets a chance to leapfrog technology.
Exactly,
Yes,
exactly.
Yeah, terrific. Look, I'm very sorry, but we are totally out of time. In fact, we've run over. I'd like to thank my panelists, Anthony Butler, Kaiser Nazim, and Abhijit Prasad. Please thank them. And that draws to a close this conference. A few thank yous before we go. Firstly, all of our speakers throughout the session, thank you very much indeed. Thank you to the Ministry of Commerce for supporting our event. We're enormously grateful for that. Thank you to our partners, DMCC. We could not have done this without you, and we look forward to many future collaborations. Thank you to HSBC, our principal sponsor and longtime supporter of Asia House. Again, enormously grateful for your ongoing support. And thank you very much to you. Thank you for being here. Thank you for being engaged in this important issue. We will continue to have these discussions and continue to share insights and throw light onto where trade might go next. Thank you very much for the warm welcome to Dubai. We've enjoyed being here, and we'll see you again soon. Have a good day. Thank you very much.